Cash is the lifeblood of any business. If you have no cash, it's going to be really, really hard. Any person who's been in business, who's been running their own business and has struggled with cash knows exactly what I'm talking about. And it's impossible to forecast cash if you're not on an accrual-based accounting.
This is the Agency Profit Podcast, the podcast for agency owners that want to run a more profitable business that doesn't depend on them. Introducing your host, CEO and co-founder of Parakeeto, Marcel Petitpas.
Hello, everyone, and welcome back to the Agency Profit Podcast. I am thrilled to introduce you guys to somebody that I'm describing as the Michael Jordan of accounting. After reading through his bio, Chris and I have known each other for a while. We actually collaborate on consulting projects. We're doing one right now, which is exciting, and we've been friends for some time now, but I didn't realize the number of accolades this guy had in the accounting space until he sent over a bio for this podcast interview. So I'm going to try to do it justice. But he started his own CPA firm called A Better Way CPA, where he works mostly with creative agencies, digital marketing agencies, service businesses, and is a member of a whole bunch of different boards and committees. He used to do forensic accounting, which is so cool. I've never thought I would say that about accounting, but forensic accounting is really, really interesting to me. This is like taking down drug lords. I'm pretty sure this is one of the people that took down Pablo Escobar. That's probably an exaggeration. I apologize for that. He was named to the CPA Practice Advisors Top 40 Under 40. He has got every possible certification in the CPA space. I think he's got a Certified Valuation Analyst certification. He's Certified QuickBooks ProAdvisor. He also has a Data Analytics Executive Certificate from the AICPA. With all of that, I'm extremely excited to welcome you to the show today. Thank you for being here, Chris Hervochon.
Well, thank you so much for having me. I really appreciate it. I have absolutely no idea how I follow up that intro. So hopefully I can do it justice.
So Chris, man, I'm excited for this episode because I feel like we don't talk about the nitty gritty, the financial, the accounting side of agencies often enough. And so there's just so many things that I want to talk to you about. So let's jump into it. Before I do that, I would love for you to give everybody a little bit of context on why you started working with service businesses specifically. What drew you to wanting to narrow your focus in on clients that are in this space?
That's a great question. So when I started, let me go back. I've always had an affinity for marketing, going all the way back to high school. Participating in these business competitions and stuff like that. That was a big part of my high school career, and I've got friends to this day from doing that. And that was around marketing. You go to college, and then somebody says it's a good idea to major in accounting. And then, so here I am with an accounting degree, but I've always loved marketing, right? And, marketing was certainly part of the coursework that I took in college. And it's been part of my career because you go out on your own, you've got to drum up business, and that's all marketing related, right? So the basic story here is started in high school. I've always loved marketing, had to do it for my own business, had to learn a ton about it because I was doing it for myself, and, just really loved it. So to add on to that, you get one marketing agency client and you get two, and then you realize, this is the space that I want to be in. These are the types of people that I want to work with. Their business fits really well with what I do and how I like to do it. So marketing, here's the dirty little secret. Marketing agencies are a lot like accounting firms from how they operate. It's a different service, sure. It's more creative, generally speaking, but they're both service-based businesses. They operate very similarly. And so it's just a really great fit. Plus they're technology heavy. The technology is always changing. That's something that fits really well with what I do and what I like. And so it's just really been a really good fit. So I brought in a couple of different clients, and then before you know it, it smacks you in the face. And it's like, this is the niche that I need to be in. Because you get in the business and you think, well, I need a niche. Where do I find a niche? And then, before you know it, it smacks you in the face, and here we are.
So a lot of agency owners don't realize that running a service business when it comes to accounting is actually very different than almost every other service business. There are a lot of things that make a service business unique. What are some of those things that we've got to be treating differently from an accounting perspective when we're talking about agencies?
Right. So a lot of the difference happens above the margin. So your margin is your gross revenue minus all the variable costs that go into generating that gross revenue. Simple enough, right? So if you think about a retail store, your gross revenue is going to be all the stuff that you sell. So if you sell one widget for $1, that's your gross revenue. If it costs you 80 cents to buy that widget, now your gross profit is 20 cents. Easy peasy. Okay. If you're thinking about a bank, gross revenue is going to be all the interest income that you get from mortgages and loaning out money minus, the cost of obtaining that cash. So the interest that you pay on savings accounts, things like that. That's your margin. Now, agencies are service-based businesses. To get to that margin, remember, it's everything that's variable. So all the variable stuff that goes into delivering that service, it might be software, it might be ad spend, it might be assigning, your different employees to different projects to allocate their time to those specific projects and clients. So really, a lot of the difference happens above the line. In other words, to arrive at that gross margin.
Yeah, and I think the thing that a lot of folks don't understand when I start having conversation with them, I'm sure you've had this conversation a lot too, is, they're not really understanding that unlike a product business, their costs are not fixed when it comes to revenue, right? So it's not like I sell a product and the margin on that is fixed. The margin changes based on, Did we scope it properly? How many hours did we spend on it? Did we have to bring in contractors? And for some reason, this gets overlooked a lot. But I think that's what adds a lot of complexity also to accounting for service businesses.
Correct.
Now, from there, I guess the next question is, why is it so important for agencies to actually have really clean accounting data?
Really, really high level, simplest answer. The entire purpose of accounting is so that you can ask questions about your business and get accurate, reliable answers back. Period. So when you're thinking about an agency, is this project profitable? Is this service profitable? Is this niche profitable? All those things, what's, where are my fixed expenses? Where can I cut costs to be more profitable? What's too expensive? What's not expensive enough? Am I spending enough on my own marketing? All of that needs to be tracked. All of that is going to lead you to be able to answer those questions about your business.
Yep. That's pretty much it. Without clean accounting data, never mind, like you might have problems with, Uncle Sam, but being able to answer those questions 100% when you're able to have reliable financial information to make those kinds of assessments on super, super, super key. So what are some of the things that you're seeing a lot of folks that come to you and they're trying to get their accounting data, cleaned up and together? What are some of the common mistakes that you're seeing service businesses make in their accounting?
Yeah, a lot of times it's the basics. So let's start with, how often do you sit down with your CPA or your accountant, your bookkeeper, whoever it is? Hopefully it's not you doing it, right? If you're an agency owner, you're the creative type, you're really good at marketing, you're really good at creative type stuff, you're a really good designer, whatever it is, odds are that you haven't spent a significant amount of time learning accounting. If you haven't done that, you shouldn't be doing it. It's like the person who tries to put the addition on the back of the house and they've never picked up a hammer, same thing. So how often have you talked to your accountant? How often have you reviewed your books? Start there. Number 2, how often do you reconcile your accounts? And this is really, really simple, but it's, the basic of accounting. Is everything that's hitting your bank and credit card statement in your accounting software? And is everything that's in your accounting software hitting your bank or credit card statement? Start there. That's a good place to start. From an accrual perspective, what are the expenses that are happening in your business that you have not accounted for, you need to account for in that period of time that you're looking at? So in other words, you should be looking at your financials at least on a monthly basis. Quarterly is less good, but still better than never, and certainly better than once a year. If you're just sitting down to do a tax return once a year and that's all you're looking at, you're missing out because you're not going to be able to ask those questions and get those answers. So monthly basis. Now, really good example from an accrual accounting perspective. I've got somebody who comes and mows my lawn. Okay. He comes every week on a Monday, we hope, but he comes every week nonetheless. He sends me a bill on the first of the month, which I then pay, 2 or 3 days later. The expense for that is in month 1. So if he cuts my lawn in October, I should be paying that expense in November, but the expense needs to be reflected in my books in October, not in November. That's accrual-based accounting. It's matching the activity with the expense or the revenue when it actually happened, not so much when you receive the cash or when you paid the cash. Looking at things on an accrual basis is certainly a change for a lot of people, especially small businesses. But it's something that you really need to do because there's no way to forecast cash accurately if you're not using an accrual-based accounting system. It doesn't provide complete answers when you go to ask those questions. How is my business really doing? How is it looking for next month? You can't ask those questions if you're not on an accrual basis. So
I want to dig into this for just a moment because I think this is a super important thing to talk about. And it's one that I'm amazed that so many people are not aware of. But I remember the first time I heard about accrual accounting, it was years ago. And somebody told me that it was really just for big businesses, right? Because I was in a different market where I didn't need to do accrual accounting because I was selling widgets, right? But in service-based business, the accrual accounting is super key because it's reflective of the business model. It's reflective of the way that value is earned and value is actually accrued over time. So I think for everyone that's listening, if you run a service-based business, you should be doing your books and your accounting on an accrual basis so that you can actually get accurate insights into your business. So
yeah, the only exception to that is really small service-based businesses. And the reason is because accrual-based accounting is more time intensive. It does require more expertise. And so to do it is more expensive, right? So you don't want to eat up, a ton of your profits and doing accrual-based accounting if really you're not going to get the benefit from it. But there is a line there somewhere where the business is big enough. You need to be forecasting cash flow on a monthly basis, and you're scaling. When you're in that scaling mode, yeah, for sure, you need to be on accrual-based accounting.
Yeah. And just so that everyone's clear on that, what is it about the service business model that lends itself so well to accrual accounting?
Great question. If you think about a scope of work that you've sold and you're going to be doing it over many months, let's just say you've got a 6-month contract where you're delivering some sort of a service, and let's just say it's $100 a month. And let's just say you're going to get a 50% deposit up front and you're going to get paid, after the 6 months, maybe in month 7, maybe in month 8, maybe never, hopefully not. But under the cash basis of accounting, you would recognize, say, $300 right up front when you sold it, when the contract is sold, because you got a 50% deposit, 50% of $600, $300. So that's your revenue for the next 6 months for that contract, or maybe even 7 or 8 months, maybe 9 months. Who knows? Depends on your collection cycle. That's all you're going to recognize. When in reality, the first month, you're going to do 1/6 of the work. The next month, you're going to do 1/6 of the work, and so on and so forth until you're done. That's when you've performed the work. That's when you've earned the revenue. The client is going to owe you based on the work you've already done, hopefully, if you've structured your contract correctly. And so you should be accruing this revenue over a period of 6 months so that it accurately reflects the work that you have done. Okay. Now, if you don't, you're going to have $300 in month 1 and then $300 in month 9, and it's not reflective of how the business is actually operating. It's not reflective of the work that you've sold, the work that you've performed. It's going to look like you've done nothing, right? The same is also true on an expense side, and it's much more dangerous on an expense side because then you lose sight of your expenses. You don't know what's hanging out there. It's impossible to forecast cash flow. You think you've got a ton of cash in the bank. In reality, it's all spoken for. It makes it very, very difficult. So that's why it's so important. It's not like when you're just selling widgets and well, look, I can't accrue anything because I haven't done the work. When the widget is sold, I get the cash and it's done. Easy, right? It's much more complex and much more nuanced with a service-based business.
Yeah, and I like your important point about how it impacts expenses too, right? Because especially if you run an agency where you're bringing in a lot of contractors or you're, bringing in a lot of outsourced work to kind of help deliver projects, there needs to be a clear picture of when that work is being done by those outside people, when they're earning their piece of the pie, so that, to your point, if you take a big deposit of, let's call it $100,000 at the start of a project, you know how much of that actually belongs to you, and you know how much of that you can actually use to run your business versus how much of it belongs to somebody else. And it avoids you being in this mode where, I'm sure you see this all the time as well, you're looking at your bank account and you're looking at the number in there and you're like, that's how much money I have. When in the reality is that is not how much money you have. It's way more complex than that.
Yeah, for sure. And cash is the lifeblood of any business. If you have no cash, it's going to be really, really hard. Any person who's been in business, who's been running their own business, and has struggled with cash knows exactly what I'm talking about. And it's impossible to forecast cash if you're not on an accrual-based accounting. I mean, you can do it, but it's not going to be nearly as accurate. It's not going to be nearly as informative. And, back to the whole thing about accounting where you're making decisions based on information that's incomplete or inaccurate. And you can't ask the question of your business.
Yeah. All right. So there you have it, guys. Accrual accounting. You got to do it right. I have one really specific, and I think this is great. We can get nerdy here because that's what the podcast is about, is around revenue recognition for accrual accounting. So even the folks that I talk to that are doing accrual, if their accountant or their CPA is not super well versed in service businesses, they're not really clear on what the best way to realize revenue is on an accrual basis. And obviously there's different ways to do this. You can look at the amount of hours that were worked. You can look at a percent complete of the project, which is a little bit more subjective. You can look at just spreading that amount of revenue out evenly over time, which for most projects is not a realistic thing. From your perspective, what's the best way to do revenue recognition when it comes to accrual accounting?
It's a great question. You really need to start with the contract. What does the contract say? If the contract says that it's going to be based on specific deliverables, then base your revenue recognition on those specific deliverables. If the contract says that it's going to be there's one deliverable and you're doing it over a period of time. If it were me, I would allocate it based on the amount of time that's been spent on that particular project. But to get down to the really nitty gritty, look at the contract first. The contract's going to dictate it and then go to some sort of other allocation method, and they all get you to the same place. It should be that you've recognized, in my prior example, the revenue over 6 months, however that's going to look. But it really depends on, what the deliverable is, when it's deliverable, and then the amount of time that you've spent.
Yeah. Okay. Interesting. So think about it at the contract level and work off of that. Okay. So now rolling back up to the original question I asked you like 15 minutes ago, which is what are the most common mistakes you're seeing people make? So obviously not using accrual accounting or not doing accrual accounting is one of them. Any other major things that you see people coming to you with that they're not quite doing right when it comes to accounting for their agency?
Yes, inadequate or no systems. So if you're the one who's doing your accounting on an Excel spreadsheet, no bueno, no good. You need actual accounting software. You need applications that play well with that software. Your accounting software should be cloud-based, not desktop-based. The reason being is if you have an accountant, well, one of the reasons being, and this is a little bit self-serving, but if you have an accountant who's halfway across the country, we could be looking at the same numbers in real time doing the same thing. Number one. Number two, what you effectively do with cloud-based accounting systems is offload the security to somebody who's probably a lot better at it than you are, because you do have client data in there. It is your data too, so you want it to be protected. And there's been a lot of things lately around, hackers targeting these hosted type platforms for like QuickBooks Desktop and things like that. So just make it easy to go to the cloud. The third thing is that cloud-based accounting systems make it easier to plug in other applications. So maybe it's a bill pay system that you have. Maybe it's an expense tracking system if you've got employees who are submitting expense reports on a regular basis, or maybe it's just other marketing data that you can then combine with your financial data to make it leverage data. So that's one of the things I talk a lot about is financial data plus non-financial data equals leverage data. When you can combine the two things, you can get greater insights out of it. I know that's something that's near and dear to your heart as well. But that's the cloud. The cloud allows for that. So inadequate systems, to answer your question very briefly and to summarize it would be the fourth thing.
Awesome. So we've got not looking at it on a regular basis, doing it themselves. We've got not using the accrual method of accounting, and then of course not using the right tools and processes to get things done on a regular basis in an accurate way that's safe and that is usable and referenceable from a data perspective.
Absolutely. And the downstream impact of all of those things is, number one, you can't ask good questions about your business. And then number two, if all of that stuff is inaccurate, good luck with your tax return. Yeah, which is probably the worst part of it all, because nobody wants to owe money to the government. They're probably the worst loan shark in the country. That's exactly right.
Yeah. Awesome. So from there, I think there's some other cool things that we can talk about, like cash. So we talked about the importance of cash. I've seen many, many, many examples of agencies that did not have enough cash in their business. And of course, if you run an agency, you've had ebbs and flows, right? You've had busy times where you're crushing it. You're making so much money, you don't even know what to do with it all. And then you have times where you're stuck in the doldrums and there's no work coming in and you're not really sure what's going on. Clients aren't signing contracts, payroll's coming up. And you're like, geez, we're cutting it really, really close. So what kind of cash reserves should agencies be thinking about putting aside in order to help them kind of survive the ebbs and flows that are a natural part of running a service business?
I love this question. So thank you for asking it. My recommendation is between 2 and 6 months of fixed expenses. How you get there is going to be different for every single agency.
Let's be clear about fixed expenses. Let's talk about that for a second.
Yeah,
what does fixed expenses mean? Let's define that.
Those are expenses that are going to exist in the business whether or not you generate $1 of revenue tomorrow. So remember we talked earlier about margins. So margins is all variable. So your revenue is variable. You're not guaranteed to have revenue tomorrow. And the expenses to generate that revenue, they're also variable to get you down to a margin. Because if you don't have the revenue, you're not going to have those expenses. So fixed expenses are all the stuff that's in your business that is not going to go away. It's salaries and wages. It's your rent. It's to some extent software expense. All the stuff that is fixed, that is going to happen regardless, that you're going to incur tomorrow. It should also include the owner's pay.
Right.
Because what you're taking out of the business because you're going to need to survive too. So that's going to make more sense here in a minute or so. Now, there are mathematical formulas that are out there. There's probably less than a handful that will quantify for you how much cash you should have in your business. I've looked at them. In my mind, really, they apply more to large publicly traded companies than they do to small service-based businesses. You know, the mom and pop shop. I'm doing the air quotes. So in reality, when we're figuring out, well, should it be 2 months of fixed expenses that I should keep in reserves or should it be 6 months? It's what I call the can you sleep at night index. And what I do, and I'm sure that you'll link to this in the show notes, or I would appreciate if you did.
Absolutely. You've got a calculator, right?
I've got a calculator on my website. Yeah. That's right. Thanks for the shameless plug.
It's in the show notes, ladies and gentlemen.
Perfect. So there's a number of questions that I asked that basically get you to a number that is comfortable for you, that you would have sitting in a bank where you can literally sleep at night. And it's going to fall somewhere between 2 and 6 months. But it's going to be dependent on what does your revenue pipeline look like? What does your growth look like? What are your expectations for how much you're going to have to invest in the business? In other words, if you know that you're going to have to bring on another employee, if you know that you're going to have to do some huge software upgrade, if you know that you're going to have to, replace everybody's laptop, those are investments. What does that look like from a personal perspective? What is your personal liquidity like? And I think there's 9 of those questions, but it's all around what do you think about the business? How does it make you feel? And then if you feel less good about the business, you're going to need to have more cash in order to make you feel better about where you are. So you'd be closer to that 6-month window. And if you feel really great about the business, it's humming along, your growth rate is just crazy. You're personally, financially really solvent. The revenue pipeline looks awesome. You don't really have that much expense sitting in the pipeline, then you're going to be closer to 2 months. But 2 months, that's your floor. And then 6 months, that's really your ceiling. If you go beyond that 6 months and you have just a bunch of cash in the business that you're not investing into something else, then it's just a waste. In some cases, that's a really bad idea. And if you have less than 2 months, generally you're just, operate on a shoestring and you're kind of looking for where your next check's going to come from. And that's never comfortable. So, that cash balance, that cash reserve really needs to happen first before you start thinking about investing and scaling and all those sorts of things.
Hey, it's Marcel here from Parakeeto, and I just wanted to take a moment to thank you for tuning in and enjoying the Agency Profit Podcast. I hope you're getting a ton of value out of today's episode, and if you are, then you might want to check out some of the other great resources that we've created to help agency owners be more successful and profitable over at parakeeto.com. We have our blog, which is loaded with other podcast episodes, as well as blog posts that detail a lot of things that we might be talking about today, and a ton of free downloadable resources, checklists, cheat sheets, worksheets, spreadsheet templates, all to help you get everything that you need to be more profitable without having to use anything that's paid or any additional software. And then of course, while you're there, you might want to check out our software product, Parakeeto, that helps you run more profitably by answering your most important operations questions without having you waste time on spreadsheets, and even lets you run simulations so you can figure out what happens if we get a new client or we hire a new employee, and really model that before you make the decision. But that's enough about me and our products. I'll let you get back to the episode. I hope you enjoy it. No, I love this framework, and the calculator is great, by the way, guys. So go check that out. It's really easy. You fill out, you answer a few questions, and it helps you get an understanding of how many months of fixed expenses you should have set aside. And it really comes back to, I think, a lot of the things that John Garudi talked about on the podcast, which is like, what's the risk level in your business, right? So how much revenue is recurring? How much of it's project-based? How quickly are you growing? All this other stuff. But it really just comes down to like higher risk, have more cash. It's a pretty straightforward equation. So make sure you guys check that out. I like that. So this actually leads me to another question, which is around, a lot of people will get tied up in the minutia of like, well, where do we put that money? And I think a lot of that depends on like, is it in the business? Do I take it out, hold it personally, a different thing? And I think that comes back to what kind of corporate entity you have and what's going to be tax efficient. So from your perspective, how should agencies be thinking about the right corporate entity for them based on where they're at in their business?
Right. So the vast majority of my clients are S Corps. So here in the States, that's a pass-through entity. The benefits of an S Corp are generally that it helps you to save money on taxes from a self-employment tax perspective. So it's a little bit more tax efficient than a sole proprietorship. Your other option, if you've got multiple members of the entity, so you have multiple partners, multiple owners, however you want to phrase it, is a partnership. There are drawbacks and there are pros and cons to each. The S Corp is a little bit more difficult to manage. There are hoops that you have to jump through every single year. You've got to pay yourself reasonable compensation, which is a whole other topic that we can get into later if you want. You've got to have corporate minutes, things like that. Otherwise you lose the S Corp status, and that's no good. You don't want to do that. So generally they're all S Corps because there is some tax efficiency there. The fallback would be partnership for entities with multiple owners or multiple partners. And then beyond that, it would be, your sole proprietorship. So the sole proprietorship would be the alternative to the partnership if you're not going to be an S Corp and if you're only one person. Corporations historically, so your C Corps, have been tax inefficient. They do have their time and their place, and they are a little bit more attractive after the Tax Cuts and Jobs Act, which was TICJA, as it's affectionately known as, which was the big tax legislation here in 2017. But generally speaking, that's probably not going to be an option.
Okay, so there you have it, S Corp. And if you have an S Corp, and of course you want to create your cash reserves, where are you putting that money? Are you keeping it in the company?
Yeah. If you're a cash reserve that is for the company is kept in the company. Now, from a revenue perspective, these are all pass-through entities, and it's, the income and all that's going to flow through to the owner. But from the actual cash perspective, where the cash is being held, it's going to be held with the entity.
Well, there you have it, folks. Just like that, black and white. I love it. So from there, I want to get into another question, which is, I think, an area that's super, super important that not enough people think about, which is their chart of accounts, because that is really kind of the foundation, the building blocks on which the insights that you get from your accounting data is built, or at least the ease with which you get to the insights that you want is built. So I think this is something that a lot of people don't really think about a whole lot when they're setting up QuickBooks for the first time, or if they're hiring an accountant that doesn't really know a whole lot about service businesses, are just going to copy paste whatever generic template is in there. And then to try and answer the questions that they want to answer, they've got to sift through a ton of data and do a bunch of math. And it's really a big pain in the ass. So when it comes to setting up your chart of accounts as a service business, what are some of the best practices we want to make sure we're watching out for there?
Okay. The biggest problem I generally see is what we would refer to as a sprawling chart of accounts. Where you've got a separate account, meaning a separate, call it bucket. So when we say account, what we really need is a bucket where you would put activity. So in other words, rent goes in a rent bucket or a rent account. And the chart of accounts is basically just, the total listing of all of the accounts that you have for your business. That said, biggest mistake is a sprawling chart of accounts where you've got one account for every little transaction. So if you have accounts that, on a very regular basis have one transaction in them per month or one transaction in them per year, you've got way too many accounts in your chart of accounts. makes it very difficult to manage. It makes it very difficult to do the accounting because now you're splitting hairs on how you're going to classify this transaction or that transaction. Was this, I took a client to the baseball game. Is it travel meals or is it entertainment meals? Who knows? Right. But, that's what happens when you've got too many accounts. So smaller is better generally. Now, the two biggest things are, number one, you've got to be able to get to a good margin. And we talked about that a little bit earlier. So gross profit margin is everything that's variable. Revenue is variable. And then all the expenses that are variable to achieve that revenue. That is what gets you to your gross margin. And again, you want to have as many accounts as you need. So you're probably going to need a revenue account for every different line of business that you have. You're also going to need a cost of goods sold or a selling expense, however you want to call it, account for contract labor. So if you're bringing in freelancers to write blogs, or if you're bringing in freelancers to do logo design, there should be some sort of a contract labor component there or an account. Anything that's variable as far as software, if you're hosting websites, that's going to be variable. That's a really good example because you bring on one more, you got another hosting fee. That's totally variable, right? You would not have had that expense had you not brought on that extra website. That's variable. It goes above the line. So that's one, getting to a good margin. Number two, how you break out wages. In the S Corp example that I gave a few minutes ago, you should have an owner's compensation bucket, or actually you should have a couple of buckets. And then you should have everybody else. Reason being is because you want to identify those items separately when you go to do the tax return. And then you also want to identify those items to make sure that you're staying on top of your reasonable compensation. So those are the two biggest things, the three biggest things really. Number one, get to a good margin. Number two, break out your salaries and wages so that it's owners and non-owners. And then number three, make sure that your chart of accounts isn't enormous because it is impossible to manage.
And I think it's important to think about, when you're setting up a chart of accounts, you have to be thinking about what kind of things what kind of questions do I want to answer on a regular basis in mind? So like if you want to know what your customer acquisition cost is, well, then your chart of accounts should be set up so that you can look at a line, understand what your loaded marketing and sales costs were, and easily go divide that by the amount of customers you had and figure out your customer acquisition cost, right? So, it's really a function of like, what are the questions I'm trying to answer? And then your chart of accounts should kind of support those insights that you're trying to get to, right?
100%.
Yeah. So I love those insights. So from there, again, I want to get nerdy because we can do that here. I think a lot of people get confused about, what is really the fundamental difference from this perspective on a freelancer versus a full-time employee and how those get put into the accounting system.
Okay. And this is a great question. Freelancers, generally speaking, are going to go above the line because you're only going to bring them on for certain projects, certain clients, certain services, whatever it is. So again, they're 100% variable because you've already generated some sort of revenue, or you think that you're going to generate revenue because you have a signed contract. So that's why you're bringing them on. So they go above the line, number one. So there, like I was saying a couple of minutes ago, there should be some sort of a contract labor line in your chart of accounts to get you to that gross profit number. Number two,
I want to make one quick note on that is like, I think a lot of people are tied up with the idea of the relationship or the contractual relationship they have with an individual as it relates to, are they an employee or are they a contractor? But I think it comes back to, this is an important point that you're making about the relationship that person has with variability. So if you have a person that isn't technically, an employee of the company, but you pay them $2,000 a month, whether you have work or not. And, then that's going to be more of a fixed cost than it is a variable cost, right? So yeah, technically they're a contractor, but I think it's important for people to understand that that's how we have to think about this.
100%. And another thing that you really need to think about, especially here in the States, I'm assuming it's at least somewhat similar in Canada, is how you classify people between contractors and employees. So if you control how, when, and why they do their work, and you provide training and you provide the equipment and the software and all of that stuff, they're an employee. If they can do the work unsupervised, they're going to basically just provide you a deliverable. You don't care how they get to that deliverable. You just want the deliverable. It's variable. You're not controlling where they work or when they work. Then they're a contractor. Most businesses want more contractors because contractors are cheaper. And the reason that they're cheaper is because you don't have to pay benefits. You don't have to pay employer taxes. That's another 7.65% here in the States. You don't have to pay vacation time, all that stuff. So generally speaking, when we're thinking about an employee, say you pay them $100, on average, it's going to be somewhere between 25 and 30% is going to be all that extra tax and benefits cost. So if you pay them $100, in reality, they could be costing you $130. Whereas if you pay a contractor $100, you're paying them $100, and that's what they cost. So it's much cheaper and it's much more efficient. Now, the flip side of that is for the contractor, you're putting the taxes and the medical insurance and all that back on them. So it puts them in a different position. But that's a conversation for another time. So there's two components here. One, are they fixed or are they variable? And then number two, are they really contractors or are they really employees? You got to be really careful because that's a really good way to get yourself in trouble.
Right. So let's talk about this then. Obviously, you've got the pretty clear cut employee versus contractor, where you've got the employees, they're going to go, into fixed costs and their salaries are going to get allocated. We'll talk about that in a second. And then You've got the contractor that you just bring in for the project. You pay them a certain amount and then they go away after the project is done. But what about that kind of like freelance / like the gray area, the ambiguous, where you've got this person that you've basically got on a retainer, let's call it for $2,000 a month, and they come in and they do work. But if there's no work for you, you don't just send them packing. Like, how would you account for them in your accounting data to make sure that it's an accurate reflection of your business's economics?
Sure. So if you're paying them $2,000 a month, every month, it just is what it is. They're a fixed cost. And then you can allocate, and we're going to talk about this in a minute, and then you can allocate their time to projects and stuff like that so that, a portion of it becomes variable, in your financial reporting. But you need to ask those same questions. So just because you're paying $2,000 a month, that would make them lean toward employee. But the rest of it, you have to ask the question. Are you controlling when and where they do the work? Are you providing them with a laptop? Are you providing them with software? Are you providing them with training? Then you get into that whole employee thing, and then really they're not contractors or freelancers anymore. They're employees, but you got to be really careful. But in those, so in that particular case with the freelancer, they can either be totally variable, they could be totally fixed, or they could be some combination of the two.
Right. Okay. So moving on to the next point, which is like, how do you actually start to allocate salaries and, these, I don't know what we want to call them, these gray area contractors. How do you start allocating, their salaries to get accurate reporting inside of your accounting?
And I think you're going to appreciate this answer, but it starts with time tracking.
I do appreciate that answer.
Good. I'm glad. With a contractor, you could ask them you could do a couple of things. One, or a freelancer, as we like to put. You could ask them to track their time on your system. You could ask them to track their time on their own system, or you could ask them to provide estimates. If you're paying them $2,000 a month, you can ask them to provide some sort of an estimate where they allocate their time to multiple projects. And then that's how you would allocate it. But it starts with time tracking, because otherwise there's really no other way. There's no data-based way to go and allocate it. At the end of the day, really, it's cost accounting, and then you could allocate anything however you want based on any model that you really come up with. But if it's going to be a data-driven approach, if it's going to be based on some sort of a reality, it needs to start with time tracking. So you take employee number one, you pay them $100, 12% of their time goes to client A. Well, then $12 goes to client A, that particular project. $20 goes to client B because they spent 20% of their time on that. And then you allocate that as well. Now you got to make sure that when you're allocating those expenses, that you're allocating the fully loaded expenses. And that gets back to what I talked to a couple of minutes ago. Salaries, benefits, taxes, the full cost of having that employee is what you want to allocate. You can't just allocate the salary.
Right. And so you're taking their fully loaded cost, and then to get to, like a cost per hour, you're basically just dividing it by all the billable time that they're working over the course of a year. Correct.
Awesome. So some employees work more, and so they're less than employees who are paid the same and work less. Right. Because you're getting more productivity out of them theoretically.
Well, there you have it. And then from there, then I think it's important to define like what is gross profit and what is net profit. Because I think a lot of agencies now are starting to look at gross profit on projects, so I think is a good thing. But then a lot of them are actually not clear on what that means and what should and shouldn't be factored into that. So from your experience working with clients, what is the definition of gross profit and what are some of the benchmarks that you see them kind of aiming for?
Sure. So gross profit, gross revenue, minus all of the variable costs that go into generating that revenue. So expenses that you would not generate otherwise if it were not for generating that revenue. That's your gross profit. You want to be aiming for a number that is as high as possible. And I know that that's a very ambiguous way to say that, but everybody's different because everybody operates differently. What we're seeing a lot of now are agencies that have fully distributed teams. So if you have a fully distributed team, you're probably working from home, you don't have any rent, and you can operate in a way from a financial perspective that's very efficient, your margins are probably going to be pretty high. I've got agency clients who do that. I mean, their margins are really in excess of like 90%. It's crazy. They're the outlier, and they're also small, so they don't do accrual accounting and they don't allocate time and stuff like that. So they're an outlier, but the number that they make decisions based off of is that 90% number. It's crazy, but it happens. Now, more realistically, you should probably be, somewhere between 60 and 80%, depending on how you operate. That's from a gross perspective. Now,
so this would be factoring in, your cost of goods sold, that gets you to adjusted gross income, and then time allocated, so basically the cost of the employees that worked on that.
Correct.
Yeah.
Correct. And it's going to be dependent on the agency and how they operate and things like that. But somewhere in that realm, I would consider to be normal.
Yeah.
Now, when you're talking about net profit, that's otherwise affectionately referred to as the bottom line. So it doesn't matter how you do allocations. It doesn't matter, what's variable, what's fixed. It doesn't matter. It's your gross revenue minus all the stuff that goes out. So it's your cost of goods sold, it's your variable expenses, it's your salaries, your wages, your taxes. Payroll taxes, rent, software, the whole kit and caboodle. That's your bottom line. That's what the business made for that period of time. So it's really kind of interesting because that, if you're going to compare agencies to agencies, that's really what you should look at, because everything else in between, you can shift it around so it looks one way or the other. It's really about what that agency owner wants to ask of their business. So that's going to determine the structure of the chart of accounts. So that's the middle. But in reality, the bottom line is what really matters.
Yeah. And that's probably the number that most people are familiar with, because I think for a lot of folks, their relationship with the accountant is once a year, they go and sit down, the accountant shows them that number on a piece of paper, and they either go drinking because they're happy or they go drinking because they're sad. But either way, they're having a drink, right? So
sure. And it's super easy because you just look at the bottom of the page and then you're done. Yeah. Oh, that's the number? Cool. I'm done. But there's a whole bunch of stuff that happens in the middle. That's where the complexity lies.
Definitely. All right. So this is good. And I just, for people, for reference, I think your benchmark of 60-80% growth, does make a lot of sense. Again, to your point, it depends on your business model. And net, I mean, I'm seeing the average in the industry being right around 10%. But I like to shoot for 20 to 25% net on an annual basis. And especially from like a cash perspective, if you want to have strong cash reserves and grow fast, which is expensive, those kind of profit margins are pretty necessary in order to fund that without running into scary cash crunch times, especially as you're trying to make investments to grow your business and hiring out ahead of time and stuff like that. Those are luxuries that require cash. So all good stuff. Now, the last thing I want to ask you about is around some of the ways that your clients that are most profitable, the ones that you're seeing do the best. What are some of the things that they're doing to maximize the amount of profit that they're making in their business, either from a pricing perspective or from an operations perspective?
I'm glad that you asked me about pricing. So that lets me tee up the value pricing discussion. So sure. Agencies should be pricing not based on time that they spend. They should be pricing based on the value that they deliver. And that's different for, the different forms of agencies. A really good example is, a digital direct marketing agency who is running ads. You should be, and if you're going to be more effective than, the next agency down the street, you should be charging a higher price. So maybe it's not that 15% markup that's been standard that's going away. Maybe it's, 20 or 25, or maybe it's a fixed fee. I've been seeing a little bit more fixed fee recently, and that makes me very happy. That's the way that it should be. You should be pricing based on the value that you deliver, and that needs to be measurable. So it's one thing to say to a client, it's going to be $100. It's another thing to say to them, it's $100, and this is the value that I drove to your business.
Right.
So that's one. Niching down, that's two. And then measuring what niches are most profitable. A lot of generalists, they'll support 20 different agencies or 20 different industries as an example. Well, not all 20 of those industries are going to be profitable. And you can't take, the product or the service that you delivered for industry 1 and then, apply that to industry 10, because it's just not the way that it works. Every industry is different. It's different to market for accounting firms than it is to market for manufacturers. There's totally different things. You need to know about the business. You need to know about the industry in order to be effective and in order to be efficient. So niching down is another one. And the way to pare that down is to track it. Once you start to see, look, this industry is not profitable for me. I need to axe that. I need to focus my attention on the industries that are profitable. And then number 3, just being really diligent and just really paying close attention to the expenses in your business, because they can get out of control really, really quickly, especially in a software heavy society that we have now. You subscribe to one piece of software. It's like, it's no big deal. It's $10 a month. That's cool. And then before you know it, you're not using it, and it's just lingers there. And then you add on another one and another one and another one. And it's not helping you to drive revenue. It's not helping you to drive efficiency and drive down costs in the agency. It just kind of sits there and you're paying for it because it's only $10 a month. Those things add up. But that's just one example. What you're doing with meals and entertainment, that's another good example. What you're doing or not doing with marketing, that's another good example. Your internal marketing, not your external marketing. Just being really vigilant about where all those numbers go. And that gets back to the point that I made at the beginning of this show, which is you need to be looking at your financials with somebody who's qualified to walk you through and tell you the story on a very regular basis.
I like all of those things that you just talked about, everything from making sure that you're sitting down with your accountant on a regular basis, reviewing these things, managing your expenses, the value-based pricing, which I think for most agencies, is probably a great way to increase the amount of money that you make for the amount of time that your team has to invest and the amount of cost that you get, or the amount of cost that you incur for each hour of their time. I agree with all of this stuff. So this is good stuff. So guys, if you're not value-based pricing, depending on what kind of services you offer, I'm not crazy about it for software because there's so much risk in software development. But
that's a different animal.
Yeah, for most other things that are relatively predictable, I like that. Niching down is a good way to make sure you're increasing the amount of value that you're driving. So these are all good things. So there's a couple of last things I want to plug before you take off. I think you create some really great value for people that want to become more financially savvy in their business. You've got a great YouTube show called Accounting for Marketing, which I was fortunate enough to be a guest on. So I'm going to link that up in the show notes. And I think you're also releasing a book, are you not?
I've got an ebook forthcoming. It'll be about going from freelancer to agency owner. So what I've heard, some of the feedback that I've heard is there's all sorts of financial resources for freelancers. There's all sorts of financial resources for agency owners, but there's nothing for the middle. And so I'm putting together an ebook now. Should be out in the next couple of weeks or so. And title forthcoming. And that'll help to address that. I'm hoping that that's going to be a resource to help you transition from freelancer to agency owner.
Awesome. So if you're listening to this and you're interested in the book, you should go to where in order to get notified when that book comes out?
BetterWayCPA.com, and it'll be right there on the homepage.
Awesome. And make sure you subscribe to the YouTube channel. I'm sure you'll be talking about it on there as well. So I'll leave information to Chris's website, the YouTube show, the calculator as well, all down in the show notes. So make sure you go check that out if you're looking for more information on Chris or any of the information that he shared today. So with that, we've gone on for a long time. This has been one of the nerdiest conversations I've had, but also probably one of the most valuable. So I hope that everyone listening at home got a lot of value from this. And Chris, I can't thank you enough for taking the time to be on the show, man. Really appreciate it. Thanks so much for having me. It's been a lot of fun. I really appreciate it. All right. Well, with that, I hope you guys enjoyed the show. Leave us a comment, let you know what you got from it, and I will see you in the next episode. That's all for today's episode of the Agency Profit Podcast. If you enjoyed the show, make sure you subscribe right here so you never miss another episode. And if you want to keep watching, we've got another one queued up for you right here. And of course, head to Parakeeto.com if you want to check out more of our content and free resources to help you improve your agency's profitability. See you on the next episode.